Hi, I'm Erica Martinez with Paragon Accountants, and today I'm here to break down the differences between the individual retirement plan options out there, so stay tuned. Did you know that the average American has less than $110,000 saved for retirement? That equates to roughly 3 years worth of retirement savings to carry you through your entire retirement lifespan. Well, let me let you in on a well-known secret. The traditional IRA, within limitations, is still eligible for a 2021 contribution that will reduce your tax burden, essentially paying for itself. Now, who qualifies is the question. So let me break down the differences between a Roth and a traditional IRA today. Roth IRA contributions are made with after-tax dollars, meaning the tax savings is at the time of distribution and the earnings are built tax-free. A traditional IRA contribution is made with pre-tax dollars, meaning that the contributions reduce your tax burden today. Both Roth and traditional are eligible for contributions throughout the calendar year and also up to the following calendar year on or before April 15th. So for those of you still looking to reduce your tax burden, you want to listen up because we have up until April 15th, 2022 to make a contribution and reduce your 2021 tax liability. So now that I've got your attention, who qualifies and what are the limitations? Well, a traditional IRA, as I mentioned earlier, is deductible pre-tax dollars against your taxable income. But there are some qualifications per the IRS guidelines that you have to be aware of. Number one, if you have an employer-sponsored plan, your income for yourself, or if married filing joint, you and your spouse have to be within certain limit to be deductible as against your ordinary income. What are those income limits? Well, let me tell you. So, as I mentioned, traditional IRA deductibility is determined by whether you or your spouse are covered by a workplace retirement plan. That's 401k, profit sharing, or pension, and certain income levels. For 2021, those income levels are single or head of household, fully deductible for your IRA contribution if your modified adjusted gross income is $66,000 or less, partially deductible for more than $66,000 but less than $76,000. And anything above that is phased out and not deductible. For those married filing joint, fully deductible contribution for modified adjusted gross income is $105,000 or less, partial deduction for more than $105,000 but less than $125,000, and for those making more than $125,000, you are not eligible for a deduction. Those married filing separate, your partial deduction for a traditional IRA contribution has a modified adjusted gross income less than $10,000. So unfortunately, anything above $10,000 is not deductible for those married filing separate. So why is this important? Well, most people are looking to make an IRA contribution for their reduction in taxable income in the current year. If you don't understand the above limitations per the IRS guidelines, you can make the contribution but get zero tax benefit. Might not make sense. That's why you need a professional to help guide you through these specific rules and regulations when it comes to a traditional IRA. Married filing separate with more than $10,000 of modified adjusted gross income, unfortunately, no deduction for your traditional IRA contribution if you exceed the $10,000 modified adjusted gross income limit. So why is this important? Because many taxpayers are ill-advised on making a traditional IRA contribution, not knowing the IRS guidelines with employer-sponsored retirement plans and income limitations. So make sure you meet with your tax professional before you make a retirement contribution and don't reap the tax benefits. Now, let's segment into a Roth IRA contribution. As I mentioned earlier in this video, a Roth IRA contribution is made with after-tax dollars. So some might say, Why is this even of interest to me? I'm looking for the tax savings today. Well, strategically, from a financial planning perspective, those clients that visit me who are just getting into the workforce or understand that their taxable income is much lower than it will be in the future can reap the long-term benefits of a Roth IRA contribution because of the treatment of the distribution at the time of retirement. So what does that mean? That means that those who contribute to a Roth IRA contribution, if they qualify, and I'll get into the income limitations in a bit, build all of the gains in that IRA contribution tax-free at time of distribution. So a really good financial planning tip is to look at Roth IRA contributions when you're eligible, because it might make more sense for, again, those specific individuals who want to build a large diversification in their retirement planning to contribute to a Roth IRA, even if a traditional is still available to them. So let's go into the income limitations for Roth IRA contributions if you might fall in those particular guidelines and are interested. So what are the 2021 Roth income limitations for contribution? Those filers, single or head of household with modified adjusted gross income of less than $125,000 and phase out completely with income that exceed $140,000. Those married filing joint or qualified widower filers with modified adjusted gross income less than $198,000 and phases out completely once your income exceeds $208,000. Married filing separate with modified adjusted gross income, again, of $10,000 or less, qualify. Anything more than that, you're excluded from a Roth contribution. So now that we've gone over the income limitations, let's talk about how much you can contribute for 2021. In both cases, the Roth IRA and traditional IRA have a max contribution of $6,000 per year, which is subject to change year after year for inflation, per IRS guidelines. But for 2021, again, your max IRA or Roth contribution is $6,000, unless you're 59 and a half, which the IRS allows for a $1,000 catch-up. And for those of you who are really trying to stack up on your retirement savings and qualify, can contribute to both a traditional and a Roth IRA, which could equal up to $12,000 a year in retirement savings. So let's talk about the penalties and why some people are reluctant to make a traditional or Roth contribution. The largest drawback with a retirement contribution is the limitation in the accessibility of your cash, and for good reason. The purpose of an IRA, an individual retirement account, is to build a retirement savings where you build earnings of growth in your investment. So by pulling it out, it defeats the purpose. So be aware that if you're going to contribute, there is a potential 10% penalty for early withdrawal if you are less than 59 and a half in age. There are some exceptions. You want to meet with your tax professional in the event that you have or need to take an early distribution. The Roth, however, can have a distribution before the age of 59 and a half, as long as your distribution is strictly related to the contributions you've made and not the earnings. That would avoid the 10% penalty that the IRS subjects traditional IRAs to, again, if the distribution is on or before 59 and a half years of age. So be careful, meet with your tax professional or your financial advisor so that you understand the ins and outs of building your retirement and the subject or limitations related to any tax savings or penalties should you need to take an early distribution. So, thanks for watching, everyone. I hope you enjoyed this video, found it informational. Please like, share, and join us again for more tax saving tips.